Hi, it's Shane Williams, President CEO of West Red Lake Gold Mines, and we're moving into production for the Madsen Mine in Red Lake, Ontario.
Shane, good to see you. Happy New Year. I think we can still just about say that. But you've been busy over Christmas and New Year's. PFS just come out. What can you tell us?
Yeah, look, it's taken a while. It's been a lot of work by the team, a lot of expectations, obviously, as well in the market, given the history of this asset. But look, at a high level, NPV is around 315 million Canadian dollars and around $70 million cash flow per year. IR is over 255%. So a lot, good numbers, good solid numbers there. And with a project that's moving quickly into production, you know, there's as you listeners and you will know, there's very few projects moving into production in 2025 for sure. And that's key with the gold price as it is today. We've also used a conservative gold price. We've used $2,200 US dollars, and today we're in a $2,600 environment. So, yeah.
Well, you raised a couple of good points there. There's not a lot of new production happening, and not a lot of new developers getting into production 2025 or anytime soon. Margin, though, that's the one that my ears pricked up on. The IRR is significant. How are you doing that given where the AISC is?
Yeah, the real issue with that is because of the capital. There's no capital to go forward. Really, you know, we got a little bit of criticism over the year with the amount of capital we've raised, the amount of equity we've raised. You know, we've raised too much equity. But really, the culmination of that today is that, hey, we've raised all this capital, we've used it to de-risk the project, and here's the result. We have a very low, very high IRR, you know, and also we're moving quickly to production. So the combination of those creates a very, very high. I would say there's very few projects out there with that sort of IRR in place.
Well, I guess some of the other things I want to focus in on, like, and I think people might be rightly having going, well, it's only going to be 67,500 ounces of year. It's only going to be six. Well, it depends how you look at it. 6 years full production or 7.2 year life of mine. But nevertheless, it's kind of a short period of time. It's not over that magical 100,000 ounce a year production. It's not over that magical 10-year life of mine. So again, you're going to have to address those things for the market. So how do you answer those questions?
So I think it's important for people to understand the gold mining in Canada, you know, Quebec and in Ontario. There's lots of mines there that have run for 45 years. They never had more than 2 or 3 years of reserves ahead of them. That's how they mine these projects. You know, they go on forever. They just keep going. But because of the nature of deep systems, the amount of drilling they need, they define a couple of years resource ahead and they keep going. Madsen will be no different. It's a typical system. Red Lake, which is across the road from us in Red Lake, the original Red Lake mine, they've been mining since the 1800s. They never had more than 3 or 4 years reserve all that time. So the idea is you put an initial reserve in place, and then you advance the project and you keep finding more ore as you go. These systems are deep, they have lots of high grade, and that's the nature of these. So that's how I would address that. And first point. The other thing I would say is we are also uniquely positioned in that we have other satellite deposits. As you're probably aware, there's quite a few satellite deposits which we never incorporated into this study, and we also have our Rowan project. So these are sort of feeds into the Madsen base cases, I would say, and we've never even tapped really the 8 zone that's down deep, or some of this fork that we're finding, or some of this new 8 zone operate. So again, these are all higher grade than the original ounces, you know, so that higher grade coming in earlier really juices the project, really, as you know, grade. Yeah.
Right, okay, well, and I'll come back to that in a sec if I may, because I just want to stick on the economics, because like you say, I think I've been through the chat was there's a few people not quite getting it in the sense that they don't understand, you know, some of the numbers. So let's talk about some of it. You picked this asset up for cents in the dollar, right? So remind me, how many dollars had been spent on the project before you came along?
So before I came along, around $350 million. Yeah.
Right. Okay.
Canadian dollars.
Canadian dollars. So you're the beneficiary of the bulk of that being spent on the things which you are now looking to advance. There'll be some wastage in some of that spend for sure, but the bulk of it will have been useful to you. And then you've spent, you said, was it 95 plus was it 35 credit?
Yeah,
Is that,
yeah.
Those sorts of numbers.
We've spent around $100 million, call it.
Right, so you've, again, you're beneficiary of all of that previous spend. So in terms of a company soon to produce 67,500 ounces for X years, fill in the blank, you've done that quickly and you've done that quite cheaply. So that I guess that's one of the big drivers behind the margins that you're hoping to make here.
Yeah, really. And look, if you had to build this project today in Ontario where we are, as we, there's a lot, your listeners will be aware, we've had lots of blowouts in capital, we've had lots of delays in projects. A day doesn't go by where there's a project delay due to permitting, due to capital overruns, I just saw recently other projects have come out recently with delays. So, there's a lot to be said for execution, getting execution, small or big, getting right execution, having that capital under control, having permits. And okay, it's starting small, but at least you have a base to grow from. So that's really the benefit of what we have inherited.
Right, okay. And let's talk about the, I guess, the confidence around some of the numbers that you were talking about in the press release, right? So the actual costs here, because what we've seen in the past few years is blowouts along the economic studies where economic studies start off at one number in terms of whether it be the all-in or the all-in sustaining or operating costs. They've all just been occasionally by a factor different. So where's the confidence for you come from?
Yeah, look, first of all, we did a lot of benchmarking in Canada. There's a lot of benchmarking in Ontario. There's a lot of benchmarking in Quebec, which are the very similar high-grade underground mines. Look, they're running around an average of AIC of $1,400 to $1,500 an ounce. That's standard in the industry today. Some are over above that. Some are up to 2,000 even. Some of these high-cost operations. So that's the first point to set where we're starting from. The second thing that we have, and we've talked about this a little bit, is everybody loves to put a pre-feasibility out with very low numbers. 4 years down the road, the reality hits, and these are the costs. All the majors, the quarterly results are coming out of all the big majors in the next 3 or 4 months, and you'll see some big 1,500 AISCs of these big projects. So, we're in the ballpark of where we'd be, and I think the real advantage that we have is we have actual costs. We're not talking about some benchmark study that a couple of engineers did in their back room. We're spending underground development. We have labor. We have 120 people on site. We're spending. We fuel, power. We have actual costs. So we've incorporated all those in to get the actual numbers that we're using, so that there's confidence going forward that these are the real numbers.
Okay, so and again, sticking with confidence. Mining methodology, mechanized cut and fill, long hole stoping, etc. Where are the kind of red flags for you in terms of things that you got to keep on top of and understand the data?
Yeah, so the main one is development. You're probably familiar with this asset, and some of your listeners would be. This mine has been mined before, quite a few times by operators. And the key to this is getting the development in place in time to the development. The previous operator suffered a little bit like that, They didn't have enough development or drilling ahead of themselves. The key to these underground mines is lots of flexibility, lots of optionality. To get that, you need drilling ahead of yourself and development. We've put 50,000 meters of definition drilling ahead of ourselves, and we've done over 3,000 meters of development. There's been 15,000 meters of development now into this mine. So we're set up in lots of different areas. We have that previous operator were in McVeigh. They lived and breathed by McVeigh. We have Austin, South Austin, North Austin, and some of McVeigh's. Lots of flexibility to work from.
Right. Okay. And again, so sticking with the mining methodology stuff. In terms of, I know this is underground, but in terms of ground conditions, such as the historic stopes, etc., affecting, I guess, the risks and the costs for you. Do you see any problems there with what you now know?
No, we haven't seen. Look, the ground conditions. the historical mine, we've been down very, very deep in the historical mine. Everything is perfect. No ground conditions on our mine at all.
No. Okay. Interesting.
Down deeper in the 8 zone, which is down deep, there was historically some issues. But in what we're mining for the next 5 years, as per this study, there's no ground condition issues.
Right.
When I look at the historical stopes, we've excellent information around the stopes, what condition they're in, where they are, etc. And our test mining program is doing that as well. We're drilling. As we're doing our drilling, we're trying to find where these are, what condition they're in. So we've great knowledge of these to allow us to adapt our mining method.
Right, okay. And obviously, we talked in the past about the kind of ore body sort of geometry, etc. But in terms, again, just, managing the kind of geotechnical challenges, and especially things like dilution down there, what are the kind of measures that you've got in place to kind of sort of safeguard yourself?
It all comes really into the prep work that you've done. A lot of drilling into that ore body, as we've done, very, very detailed drilling. Now, not only tells us the ore, where the ore is, the ore body, but it also tells the condition of the rock. It tells where the stopes are around it, how much space we have, etc., which all feeds into the mine design. So that's part of it, getting the good data, very tightly spaced data. And, it's not just geology, it's geotechnical information. We try to extract as much data from the drill hole as we can, and that's getting that understanding of it. And then we're doing test mining as we speak. I've talked about that. They're actually test mining as we speak. And so that we'll have results. We can talk about that. That's our next big catalyst. But so far it's all looking good, and that will give a lot more detail to the teams on how we mine these areas, what we're seeing, best way of mining, etc.
That's in relation to the kind of the bulk work that you're doing, is that right?
Yeah, exactly.
And when does that actually sort of feed into when you're having to kind of hit the mill with that?
Yeah, so that's March. So
March, okay.
We're mining it at the moment. We're doing mining, and as we're doing it, we're doing the reconciliation studies we've talked about before. So they're being done on a sampling base, and then the idea is we'll have initial results, and then in March we'll put it through the mill and hopefully confirmation results. So they'll be key catalysts as we move forward.
Okay. And again, I'm going to keep coming back to this kind of confidence thing around the kind of current infrastructure and operational readiness. It sounds like that's pretty darn close. Obviously, with the bulk sampling, etc. What are the things that you've put in place, knowing what you know about how things went in the past with other groups, right? Have you got contingencies in place in terms of delays that may happen around shaft rehabilitation work or similar?
This is junior mining, Matthew. There's always risks, and so part of it is being able to build in those contingencies. So the key one for me underground is having lots of areas to mine. That development, that drilling gives lots of flexibility. Underground mining is tough. It's a lot more tougher than open pit, as you're probably aware. And things go wrong, stopes fail, you have issues on the ground, and you need to be able to pivot and have those areas. And if you don't have the development and the drilling ahead of yourself, you're very limited. And by us doing all that drilling, we've the ore defined, we've it in situ, and the idea is the development will allow us to have that flexibility. So that's one part of it. The second part of it really is we've kind of taken 18 months of a startup, if you kind of know what I mean. A lot of companies build a project and then they go into startup. We've because we had everything there, we've done 18 months of, I would call, operational readiness. Part of that is key to a starting of a mine, because we've had the people, we've had our budget processes, we've had our maintenance team, we've had everything set up as you'd operate a mine. So that's key. A lot of companies, as you're well aware, they do a project and then they say, we can go straight into operations. And that's where they fall down a little bit. But we've done it the opposite way. We've kind of done 18 months of operational readiness, and that's key. Procedures, systems, managing costs, how we manage costs, store systems. A lot of people forget about that. That's probably the hardest part, which causes the most failures in my experience in building mines. And if you don't have that operational readiness point, you're really in trouble. You're really in trouble.
Right. Okay. Okay. Look, I'm sure we'll talk about it as you go on, especially when it comes to, as you say. I guess you got to kind of stick to the knitting first. You're starting conservatively to build the cash flow to fund the expansion, etc. So let's talk about the first part of that, and we sort of have already, which is around the kind of processing recovery component. Good recovery rates. But people will look at this and go, like, 800 tonne per day, it's not that ambitious at the moment, but you'll say, I've got to get it right. So in terms of that, optimizing that 800 tonne per day component before you kind of, increase that further down the line. What are you doing at the moment with this kind of bulk sampling and understanding, downtime risks when it comes to kind of that recommissioning?
Yeah, really this bulk sample is to get, we have a team recently there who's are doing pre-commissioning for the mill at the moment. We've done a lot of work underground, a lot of mining, a lot of work areas. We haven't really done the mill. The mill, as it was already built. It hasn't. We had to get back in, understand the mill, recommission it, look at systems, go through all the systems to understand. So this bulk sample will test the back end of the process, really. The milling rates, our tailings, that management, all that area will be tested in this test mining program, as well as our ability to go underground, mine, pull that material at 800 tons a day from underground, build a stockpile. So that's again like a mini pilot plant process ahead of the main start.
Right, and obviously you've got what you inherited there in a sense, plus how you rehabilitate it. But how does one build it from 800 tonne a day to, how do you double that? How do you treble that? If indeed that's where you want to go, is that a modular process? Is it costly? How do you view that?
Just to give viewers an understanding, or listeners, the mill was running at 1,100 tons a day during the pure gold time. So the mill is capable of that. There's a limit we've put on it at 800 tons a day, but it can run to 1,100 tons a day with no changes, no capital, nothing additional today. So that's the first point. It can be squeezed a little bit to there. That's a 20%, 30% increase on the existing mine very quickly. It can actually go to 1,500 tons a day with a modest capital increase of around $35 million. So, you can get to a 1,500 tonne a day, which is double what we're talking about if you look at like for like. So there's 100,000 ounces a year roughly at the same, if you just do the maths on it. So that gives you the opportunity. And the real benefit for us is bringing in the higher grade material. That's where you really get the benefit. The Rowan is a 12 gram ore body. You have the 7-8 they're in Madsen, you bring in 12 gram, you bring in 8 zone, you really get sweetened in grade. Grade makes a big difference. In the last couple of years in this study, as you see in our press release, the cash flow really gets juiced in the last 3 or 4 years, well over $100 million, because we're bringing in the top part of that 8 zone, that 14 gram material. There's a cash flow model there. So that's really where you see, if you could bring that forward, bring the grade forward, bring the throughput up, that's where you really turn around this project and becomes a real project.
But talk to me about ore sorting.
Yeah, so ore sorting, we've done a little bit of testing on Madsen. Madsen is not so amenable to ore sorting. Where ore sorting is really beneficial is on Rowan. So we've done a lot of work on Rowan on ore sorting. The Rowan ore body is more quartz hosted, so for the ore sorting it's much easier. And where the benefit of that is, it's already a 12 gram ore body. You could do ore sorting and bring in 15 to 17 grams of ore into the Madsen mill. And also trucking less tonnage, trucking everything. You bring that into the mill, 100 tons, 150 tons a day at 14, 15 grams. That's where you see the real benefit of this. With very little throughput increase. You don't have throughput increase, it's grade is the driver.
Right, okay. And if you, right, so we're starting with a small but perfectly formed and very profitable operation here. When do you think you get through this phase 1 component? You gave some clues at the beginning of this conversation about some of the expansion opportunities, Rowan obviously being one of them, but there's a bunch of things that you could do. So let's just finish off the phase 1 bit. You talked about in March, obviously being in a position to kind of process that bulk. how long does that run for? And then when do you actually start producing? When are you looking in the future to be able to producing enough to kind of feed that 800 tonne per day?
So doing the bulk sample, getting that through will take the month of March, roughly, by the time we do that. We want to then, in parallel, build a big stockpile on surface, because at any startup, you need a stockpile, issues go wrong. So that's part of it. And probably mid-year is when we're looking at to really ramp up and go into full production, as I would call it. Get the production going. Just so your listeners will understand, it's minus 35 in Red Lake at the moment. It's a never good time to be starting a mill in minus 35 for sure. Things go wrong. It's a lot of water moving around. It can get ugly sometimes. So, again, we've kept it to the back towards the middle of the year when the weather is, et cetera, just to de-risk again ourselves.
Right. Okay. That's really interesting. Actually, people do forget about the kind of almost seasonality components here. Minus 35 is not good to do lots of things. But at the back end, of the mill, when the stuff is kind of run through it, what actually happens there? What are the things you're trying to manage and risks you're trying to mitigate at the kind of back end of the processing?
Yeah, really the tailings management, getting tailings management and getting water management as well. We've had water management running for quite a while. We haven't had tailings, pumping tailings, moving tailings, getting that done. That's another area that has never been looked at because we're under care and maintenance. So, the back end, as you would say, the processing, getting recovery up to the right rates, making sure the plant is working as it should be, and then getting tailings. And we also have backfill. There's a backfill plant that was built for $50 million actually during the Pure Gold times. It was never used. So getting that going, using that material to build our backfill plant to be able to mine. Those are some of the key next stage risks as we move forward.
Right. Okay. So, understood. So the timing is mid-year to actually start, ramping up, filling that mill, and that is spitting out cash. You've got good margin. Whatever people are thinking about the ASIC, they've got to remember your cost of capital and your capex and your opex is extremely low for the kind of numbers you're talking about.
Well, I would also add, just sorry to, we're in Canadian dollars, and our poor Canadian dollar is getting hit quite hard today. So, there's a 15% increase in Canadian producers now because we're selling in US dollars and we're producing in Canadian dollars. And that's changed 15 or 20%. So that also helps your margins of Canadian gold producers as well. That's a tailwind.
No, good point. Well said, and good luck, Mr. Trudeau, wherever you go. With regards to some of the other upside potential, right? So obviously you've talked about your addition of resource into reserves, etc., and some of the other targets that you're going to be looking at. You're going to be allocating capital to those, presumably. Have you got a sort of sense of what you think you need to spend this year on that expansion stuff, or would you wait till next year?
No, we won't be spending any of that. The key for us is to get into production and consistently produce and show the market that, hey, we have a plan, we're into production, steady state, we're not even thinking about an expansion. It's good to talk about it, but I find a lot of companies talk straight away about they're into production now we're looking at the big picture, and I really want to just let's get going. Let's get steady state. Let's produce cash. Let's show the markets we're there. Then we can focus on. We know the upside is there. Look, we know it's there. I know it's there. The team know it's there. But we've got to get us into production, producing, generating cash. That's the key focus now for the next.
Okay, so when you talk about Rowan, then what's the timeline on that?
So Rowan would be a year. Rowan is only an early stage exploration, so Rowan has permitting to go through. So that's a year 3, year 4 sort of scenario to build in. Some of the other deposits may be quicker. Fork is close by. Some of the satellites, but none of them are. They're at the back end of the mine life. They're mine life extensions.
Right. So would you on this like potential to go from 800/1100 to 1500 with 35 million type of range of spend on it, you would hold that off until you could feed from some of these other satellites, or you think you could bring that out of Madsen?
So the key is it's a combination of both. We need to get Madsen producing underground, that level of it produces 800 tons a day. To ramp up underground mining from 800 tons a day to 1,500 tons a day is a doubling of underground production. It's a lot for a mine like Madsen, So it's a combination of getting to higher grade parts of the ore body. Really the key here is grade. Grade is the key to these underground mines. It's not more about tons. If you can bring higher grade in, that's where you get the sweet spot, because your costs are the same and you're getting higher grade.
So tell obviously we talked about ad nauseum in the past about the complexity of what you see here, has the tight drill spacing, etc., and understanding the ore body better, etc. But I come back to this kind of dilution component. So in terms of you're getting started a kind of a bulk process at the moment, do you expect to continue to learn how to reduce the amount of dilution and mining techniques as you go along, or do you think you expect to sort of see a kind of consistent ore body and therefore a consistent process that you will be engaging with?
No, I expect that there'll be a lot of learning. Like I said, as an example, we've a lot of cut and fill in the ore body versus long hole. The team are now looking at next year. Our plan is a lot of long hole. Given where prices are, etc., and the understanding of that ore body, you reduce more, you bring in more long hole versus cut and fill, your costs come down. So there's a lot of that adaptive process, and I think because of that, I go back to my operational readiness. That only comes about from being underground, learning, experience, doing the work, and because we've done that, we have that ability to understand that areas.
Right. Okay. So again, obviously, there's been a lot happening over the kind of Christmas period for you guys. But what was the kind of, what were you sort of obviously getting this PFS out, but in terms of money, in terms of support from the market, is that still there, you feel?
Yeah, I still feel it's there. Actually, it's getting more. People are becoming more believers, Matthew. I think as we de-risk more and more, at one stage it was more me convincing everybody that Pure Gold or the old group, we can turn this around and believe us, we know what we're doing. Now it's more beginning to get that confidence as we're de-risking. They're seeing what we're doing. We get that. We understand what you're doing. This is what needs. We're getting to that phase now. And as we move over the next 6 months, I think it'll really accelerate. We have this test mining going. We have some exciting more news coming up. A lot of stuff happening in the next 6 months. And I think that'll give that more confidence to the market that, hey, we've done this. Remember, also I'll point out as well, the Nabari, we got Nabari closed at the end of this year, early this year. And so Nabari did a 3-month extensive DD process as part of that before they agreed to lend us money. And so they threw everything at us. Remember, they also invested in a project called Ascot Resources, and they also invested in another one called 9-1, who you probably know. And so both of those, they had their challenges with. So when we came along, they really said, hey guys, we need to understand this really well. And they put a lot of technical DD, they brought in all sorts of consultants, looked under the cover, and we passed. There's a lot of risk there, there is risk there, but our plans, our way of managing those risks, they were very comfortable with, given their earlier projects. So yeah, we were quite confident, they were quite confident to move forward. So I think that's a risk mitigation process.
Right, and if I look at just want to finish off on some numbers, like obviously I think you've talked about the kind of sustaining capital over the current life of mine of, over 400 million bucks for 24-30, something like that. But you've got this free cash flow of 67 million per year over that period. If you do the expansion component, everything's kind of, the expectation is that everything pays for itself. You're not going to damage the kind of free cash flow position. You should be increasing it, presumably, is what you'll be aiming for, and not just plowing it back in the ground like so many producers do, forgetting that they need to make money here. So you're aware of that. You're kind of conscious of that kind of profile in the marketplace, are you?
Yeah, unfortunately, the mining industry has not had a great return of investments or capital to investors. So yeah, very aware of that. And again, the other benefit of all this infrastructure is, we don't need to go there. We don't need to double a plant. We don't need to build a new plant. There's gradual optimizations within the plant, to get that numbers. Grade will be key. Targeting new higher grade sources of ore rather than tonnage. It's a grade game, underground mining. It's not a tonnage game, because tonnage drives capital, and we don't want to do that.
You want to drive margin.
We want to drive margin, yeah. It's a new thing to the industry, but that's what we're trying
I know, it'll never catch on. Shane, look, I appreciate the Roger. I know you got a ton of people to speak to today. I think it's a really solid start with this PFS, and as you say, focusing on margin, not necessarily, as you say, trying to look big for the sake of looking big. So appreciate your time. I look forward to speaking to you again soon, hopefully about this kind of bulk work that you're doing as well.
Excellent. Thank you very much, Matthew. Great to be on.